Double Bollinger Bands, DBBs, 3 zones, 3 rules. As noted in the last article, the 2 sets of Bollinger Bands create 3 zones. Let's look at them more closely. The DBB buy zone. When a price is within this upper zone, between the 2 topmost lines, A1 and B1, that implies strong upward momentum and that the uptrend is more likely to continue. Rule. When candles continue to close in this uppermost zone, that's a signal to enter or maintain long positions, as well as to avoid short positions and to close any remaining shorts still open. The DBB sell zone. When the candles remain in the bottom zone between the 2 lowest lines, A2 and B2, that suggests strong downward momentum and that the downtrend will probably continue. Rule. When candles continue to close in this sell zone, that's a signal to enter or maintain short positions, as well as to avoid long positions and to close any remaining open long positions. The DBB neutral zone. When price is within the area bounded by the 1 standard deviation bands, B1 and B2, that means there is no strong momentum or trend. Rule. Typically 1 to 3 consecutive candles closing in this area are your signal to exit any trades that are riding the current up or down trend, because that trend is showing weakness. In other words, when a price makes a sustained move into the neutral zone, that's a signal to exit trend-based trades. Consider range trading strategies. That is, entering long positions at the bottom of the trading range, closing them as price reaches the upper end of that range, and then opening short positions to ride the move back to the lower end of the trading range. Notice how we phrase these rules. We didn't say something like, when price is in zone X, do Y. Rather, we stuck to wording like, when price is in zone X, that's a signal to do Y. Here is a reminder. Never trade based on just one indicator. We generally would not enter a long position just because the price is hitting support, nor would we usually open a short position just because price is hitting resistance. Similarly, we wouldn't enter or exit positions solely based on DBB signals. You should generally not make entry or exit decisions based on just one technical indicator. The above signals must always be considered together with both. Other technical indicators. Look for confirmation from different kinds of indicators that it's a good time to enter or exit a position. Similarly, if there are conflicting signals from other indicators, we might wait until the picture becomes clearer. For example, if price enters the buy zone, but we know that a strong resistance area is just above the current price, we might wait until the pair makes a decisive break above that resistance before entering a new long position. How long we wait is often a decision based on how we prioritize risk versus reward. The sooner we enter, the larger our potential profits if we're correct, and the higher our risk of entering too soon and suffering a loss from a false breakout. For example, if the Euro-US dollar moves into the buy zone, but we suspect that the ECB might announce an interest rate cut at its monthly meeting and rate statement later in the week, which would likely drive the pair lower, we might ignore the technical entry signals and wait until that event passes. We'll discuss later the number and types of technical indicators we want to use in combination.